Hey everybody, my name is Cody Charnell. I'm a multifamily real estate broker with Buckingham Investments, and I'm here to talk to you about gross rent multiplier and cap rate. You may have heard people talk about gross rent multiplier and cap rate when they're referring to multifamily properties. A lot of people don't know what that means, so today I'm going to break it down for you. So one of the great things about multifamily property is that the value of the property is derived from the income that the property generates. So we can use these metrics to compare buildings of different sizes to one another. One of my favorite metrics to use is the gross rent multiplier because it's really simple. Gross rent multiplier is just the price or the value of the property divided by the gross scheduled income, which is all the rent that you collect on a property in a given year, not counting any expenses or mortgage payments. So an example of this would be, let's say, a $900,000 property that generates $60,000 a year in rental income. If we do the math, we would say that this property is priced at 15 times gross. And this is great, but it doesn't really mean anything to us unless we know what other properties in the same market are trading for on a gross rent multiplier basis. So if we were looking at this property and we saw another property down the street that was for sale that was priced at 16 times gross, well, what does that mean now? Well, another way to think about gross rent multiplier, if we turn this back into a fraction and look at it from this perspective, what we're seeing here is we're paying $15 in purchase price for every $1 of income that a property generates. So if this property down the street is priced at 16 times gross, we would be paying $16 for every $1 of income versus $15 for $1 of income. So all else being the same, lower gross rent multiplier is better. So something else you can use gross rent multiplier for is to come up with a rough estimate of value on a property. So let's say you know that a property produces $60,000 a year in gross rents. And we look at comparable sales and see that other buildings in that same market are selling for about 15 times gross. Well, we can multiply our gross rents by the going gross rent multiplier and figure out a rough estimate for value on our building. And it's just that simple. So cap rate is another metric that people will use to compare one building to another, but different from gross rent multiplier, the cap rate actually uses net income. So the equation for cap rate is just the net operating income, or NOI, divided by the price or the value of the property. And when you run the numbers on this, it will spit out a percentage. All right, so let's take a look at an easy example. So if we were to look at that same building from the gross rent multiplier example and take the $60,000 of gross income minus our expenses, and we came out with $39,000 in net operating income. So we take that net operating income divided by the value of our building, which is 900 grand, and this would spit out our cap rate, which in this case is 4.3%. So another way to think about cap rate is if you were to pay all cash for this building, this is the percentage return from cash flow that you would get after paying all of your expenses. And it's also important to remember that this net operating income doesn't count any mortgage payments. And going back to how to value properties using these metrics, if we were to take this 4.3% cap rate, we could use it to come up with an estimate of value for this building. And how you would do that is you would take your $39,000 in net operating income and divide it by the going market cap rate, which in this case we'll say it's 4.3%, and that would spit out a rough estimate of value for our building. And that's how you do that. So if you found that video helpful, check out the other content that we have. We have this video, and we also have this video.